I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, New York City says it may run out of vaccines next week. This is the CDC warns the fast-spreading UK strain is taking off in the United States. We're going to give you the latest global snapshot of COVID-19, plus how this impacts Biden's pledge of 100 million shots in his first 100 days in office. And streaming the tube, just when you thought you've literally seen it all, there's more programming on the way. Netflix pledges 70 new movies in 2021. Big plans also from Disney Plus and HBO Max. We will have the latest on the streaming wars. And she is one of the most iconic CEOs of our time. Former IBM CEO and chair Ginni Rometty looks back on her 40 years at the company and gets personal. She grants us her exit interview. All of those stories in a moment, but first, U.S. stocks dropping the most in a week as bank earnings funneled in and Wells Fargo dragged down the sector on a disappointing report. Our Ed Ludlow has the full picture. Ed, interesting on the back of Biden unveiling his economic plan. Walk us through the day.
Yeah, the market hitting pause on that reflation trade, taking time, considering the reality of what President-elect Joe Biden is actually going to get done within his stimulus plan, especially in the context of that COVID vaccine. It was bank stocks that dragged the S&P 500 lower, off by around 0.7%, but we continue to see underperformance from technology stocks. You can see there the Nasdaq 100 down by 0.7%. The NYSE FANG Plus Index, that basket of mega cap tech stocks, continues declines. It has not been a good year for some of the biggest US listed tech companies, down 1.21%. And the Philadelphia Semiconductor Index, or SOX, down 2%, snapping those gains that we saw throughout the week. The SOX had been an outperformer compared to the rest of the technology sector, but it's turned the corner and we end the week firmly in the red when it comes to US equities. In terms of some of the specific movers and points movers, Apple continuing its recent underperformance, down by 1.4%. The biggest points mover to the downside, it's only the second successive weekly decline for Apple since November. It's only had one green day this week. A Bloomberg news scoop after the bell that Apple is looking at a folding phone. It's in the early stages of looking at a folding phone, but the other big takeaway from this Bloomberg news scoop that we don't expect any major changes to the Apple iPhone lineup in 2021. The other moves I'm looking at, Facebook up 2.33% today, ending the week on a positive note. But as you know, Emily, it has been a tough week for social media stocks. Facebook itself still registering a weekly decline of 6%. Similar story for Twitter, down 1.3% on the day, a weekly decline of 12% and a second successive weekly decline. A lot of attention on social media stocks. As you know, in the wake of Twitter's decision to remove President Trump from its platform, a lot of social debate in society going on around that, and analysts continue to looking at how those decisions will impact the top and bottom line for those social media stocks throughout the rest of 2021. Emily.
Absolutely, and we'll be watching how those stocks hold up through Inauguration Day through next week. Our Ed Ludlow in San Francisco. Thanks so much, Ed, for that update. Meantime, New York City is running out of COVID-19 vaccines. Mayor Bill de Blasio says the city's supply will be gone by next week. He says if the city doesn't get a serious supply of doses, he will have to freeze the appointment system. Meantime, we're hearing the fast-spreading UK COVID strain could become the dominant strain in the U.S. soon. This is President-elect Biden has pledged a national response to the pandemic. To discuss, we're joined now by our health reporter, Bloomberg's Michelle Cortez. Michelle, first of all, what is happening in New York City?
There is just simply not enough vaccine in New York City and many other places. And the concern is that people who have already gotten a first dose of the vaccine won't be able to get their second dose to offer them the full protection. And we don't know exactly how effective just a single dose is. The challenge here is for New York City and other places is that there's not the follow-on doses. We have been told that those doses were going to be held back so that once everyone got a first dose, their second dose was being held for them and they would be able to come and get it. At this point, that is not looking like it's going to be how it holds up. And if the city doesn't get more of the vaccine from the Operation Warp Speed, then people are going to be going without that second dose.
I know we're still learning a lot of things, but if you don't get your second dose in the time frame you're supposed to take it, does that invalidate the first dose? Can you get it later?
You can get it later. We know that the first dose does offer about a 50% protection during the wait period of time until you get that second dose. And we don't know exactly how long that will last. Like if you don't get that second dose in 3 weeks after the first one, which is when you're supposed to get it if you get the Pfizer shot, or in a month later if you get Moderna's vaccine, we don't know exactly when the protection will wane. But you do need to get that second shot in order to get that 95% efficacy rate. Of course, the concern in New York City is that if they don't get that second dose, that second bolus of vaccines coming in, they're going to have to shut down the program. And then other people who are waiting to start getting their first dose will be shut out of the system entirely.
Meantime, New York City is not alone. Here in California, they've opened it up to age 65 and over, but folks in that age group have no idea how they're supposed to get the vaccine. Doctors don't know what to tell their patients. There have been some folks on the front lines just telling me anecdotally there's no tracking, no organization. What is the picture here?
Well, it's that way across the entire country. Not only that, every state has their own policy and every county can have their own policy. Not only that, every hospital or medical facility can have their own policy. So we're not exactly sure how the process is rolling out. While there are recommendations coming from the federal government and from the state government, in the end, whoever has the vaccines are the ones who are making the decisions. So we are seeing certain cases where there are people who are tangentially related to a hospital, for example, a board member or their family are getting access when patients in the hospital and some of the healthcare providers themselves do not have access. Exactly as you're saying, both the Biden administration and the Trump administration have said that we should be vaccinating everybody age 65 and older to make it easier to get to herd immunity levels, that 60 to 80% that we need in order to protect the entire country. The challenge there, of course, is that there aren't enough shots. And if you're looking at these older populations, 65 and older, many of those folks are people who struggle with things like internet connectivity. Do they have the ability to find these websites to sign up? What happens if their computers go down? So it is kind of a catastrophic situation coming. People don't know where to go. Even those who do know where to go are having trouble manipulating and getting through the processes that they need in order to sign up for those shots. And when they're there, they're competing with millions of other people who also want access to the vaccines. So it is just kind of crazy across the board. Hopefully, as more come out, it'll get smoother.
How much do you think an administration changeover can really help? I mean, Biden has this vaccine plan, less rules, more vaccines. Can he actually deliver?
You know what? I can tell you where the difference is going to be, and it's going to be in the dollars. The Biden administration has this $1.9 trillion effort that they're rolling out. $20 billion are directed just towards vaccinations. So if we have the money going to the states, that is going to really make a difference. We've seen in a lot of where it's gone sideways is because of things like not having the money and the manpower in order to get the task done. That being said, simply having money doesn't immediately make a difference. It'll make it better for things like if you need to rent out a sports stadium so that you can set up your vaccination clinic to run 24/7. But you need to have the money, you need to have the contracts. There is a lot of paperwork and process that has to happen before those dollars make a difference. But the fact that that money is coming should ultimately make the process happen more smoothly.
Michelle, thank you so much always for educating us. We could talk to you for hours. I highly recommend to our audience to check out your work and all of your reporting at Bloomberg.com. Michelle Cortez, our healthcare reporter who's been covering the vaccine race. All right, coming up, she is one of the most iconic CEOs in technology. Part of my wide-ranging conversation with former IBM chair and CEO Ginni Rometty coming up. A revealing and personal interview next. This is Bloomberg. After more than 40 years at IBM, former CEO and executive chair Ginni Rometty stepped down last month. The amount of technological changes she has seen in that time has been astounding, from the rise of personal computers and smartphones to AI, quantum computing, and the cloud. In a very special Bloomberg Studio 1.0, I sat down with Rometty as part of her exit interview, her last at the company, and asked her to recall her memory from day one on the job as a systems engineer in Detroit back in 1981.
I came from a single mom who, to get us off of food stamps, found her way back to get an associate degree so she could get a job so we could all go to school. So I start there. I'd had a scholarship from General Motors, bless them, through Northwestern University. So I first did work there. So before that, then I went to IBM. So I worked there a year, but as I've told Mary Barra, I love what she does and she is passionate about cars. I wanted to apply technology to a lot of things. So went to IBM, and here's what I'll remember of that first day. Of course, I did not have a blue suit, all right? Had not had one. I'm not sure I had any suits, actually. But this is back in time, right? So this is 1981. I had a blue suit. I can remember coming home from work, taking my jacket off, putting it on the couch, and my husband saying, "Do you realize the price tags are still on your suit?" And that's how I remember my first day. And I thought, how gracious. There wasn't a single person who said anything about that.
Your mom, how influential was she over the years?
She showed us that nobody defines your future. You do it. And we watched that and learned that by just looking at what she did.
I remember when you took this job in 2011, the New York Times wrote this big piece about your husband and how he was your support system, and as all husbands should be. And it had a big impact on me because I think we often think our support systems should be invisible, but then we don't learn how other people do it. And I'd love to know more about how that partnership evolved over the years, especially as you were CEO.
I just had my 40th wedding anniversary, and so 40 years. And you know what I say about Mark, he's my biggest fan. And I have been really blessed and lucky to have someone like that by my side who took as much pride and was tried to learn as much about IBM and be its ambassador, right? I feel he was IBM's ambassador and took as much interest in my clients as I did. So it was a real partnership. And clearly I did nothing else but work. So I have such great empathy for women that, have children and all these other responsibilities. I worked and Mark really did take care of everything else while I did work. So I was lucky from that sense.
Well, I'm sure you're selling yourself a little bit short, and he is very lucky to have you as well. I will just say that. You've said you've never thought about yourself as being a woman CEO, but that is how others have often thought of you. Did you find that frustrating over the years or unfair in any way?
So that's an interesting question from two perspectives, because I've often felt when I first became CEO, I really did not want to be labeled that. I wanted to be recognized for what I could accomplish. I think many women feel that way. I think many people feel that way. But I will tell you a different side of that story, that as time went on, I did begin to realize this obligation to be a role model. And you could see so many people that would react to not just what I did or what I said, but that you were a role model for their children, their daughter, someone, themselves. And this idea that you cannot be what you cannot see. I began to internalize that and did feel it was an obligation. And I've changed my view about that. And as my tenure went on, you saw me become, more vocal about that and more involved in things, because I realized, and whether it's a woman or any group, people have got to have role models to see what's possible. And that is, in a positive way, an obligation there. Now, with it becomes, I've said to other women as they've taken on their CEO roles, I said, get ready, because everything you do is magnified, everything you do is personalized. I can't tell you that that's fair, but it's what happens. And so just power through and do what it is you think must be done.
So what is your advice to young women out there who want to be you, who want to be leaders?
It's probably the one piece of advice I am best known for, Emily, around the world, and it is my husband that taught me the lesson. It was early in my career. I had interviewed for a job, was offered it, and I was very nervous about taking it. I didn't think I was ready. I thought I needed a few more years. And Mark had said to me when I came home, he said, because I told the person, let me think about this. And I'd come home and Mark said to me, Ginni, do you think a man would have answered the question that way? And in those moments, what I remember is that growth and comfort will never coexist. And so everyone I talk to, I say, look, you just get really comfortable with being uncomfortable. And that when you're uncomfortable, that means you're learning and growing. And so to your earlier question about fear, I view those moments as like wonderful learning opportunities, and that's my biggest advice.
So have you replayed that story to yourself over the years as you've had moments where you're saying,
100 times.
A man would not do this?
Well, what I've replayed to myself more is go put yourself at risk. Don't worry. If you're nervous about something, fantastic. Or if you're not nervous, equally a concern. Be sure you take on something different and go learn something new.
IBM's shares declined during your tenure as CEO, and I wonder if that was frustrating to watch. I know CEOs always tell us they don't pay attention to the share price, but it has to be distracting. And I wonder, is there something you think investors just didn't get?
Well, look, we did return $43 billion to shareholders during my time frame with dividend, and actually the dividend grew by 100%. But clearly, obviously, you would want your share price to grow. So, of course, to that. And I think the piece in what we had to undertake was the hard work to reinvent IBM for the long term. And that's what we went about and did. We had a tall order to address. We did it. And so I'm really looking forward to now this next chapter for the company.
Just part of my interview there with former IBM chair and CEO Ginni Rometty. You can catch our full conversation on the latest edition of Bloomberg Studio 1.0, airing tonight, 7 p.m. Eastern, and all through the weekend. She gets more personal than I've ever seen her after interviewing her many times over the years, and it's definitely a conversation that you don't want to miss. All right, coming up with the new year comes new content from the likes of Netflix, Disney Plus, and a host of video streaming providers. Competition heating up. Our coverage of the ongoing streaming wars with Rich Greenfield of Lightshed Partners next. This is Bloomberg. Streaming hitting new highs in competition in the age of COVID-19, with providers scrambling for subscribers and ramping up content spending. And on Tuesday, fourth quarter results from Netflix will give us a glimpse into the landscape for 2021. Joining us to discuss, Rich Greenfield, partner and media tech analyst with Lightshed. Rich, I gotta ask you about Netflix saying they're gonna be coming out with 70 new titles this year. How is that even possible?
70, not titles, just movies. If you were to include TV shows, it's hundreds. You're just talking movies. And I think this is really part of the goal for Netflix in 2021, is to establish itself as the world's largest movie studio. And, here's just a few years ago, Netflix wasn't in the movie business other than just distributing other people's older content. Now we're talking about Netflix being literally the biggest studio in terms of production dollars in the entire world. Remarkable.
So how are they doing it? Is it just that they're putting so much more money behind this, or funding so many more projects than, even Disney Plus?
I think Disney's starting to get it, right? I think once you get into the streaming business, you start to realize, man, this is a huge opportunity. When you look at the revenues of Netflix, if you think about a subscriber base, already up to 200 million subscribers, charging now in the US $15 a month, but globally call it, $11, $12 a month on a global basis. The scale of what the revenue and profit potential is of a subscription business versus just the traditional movie business, where you release a movie, you hope and pray it works, you market it, then it comes out and you hope it gets the DVD and you market it again. That business is so much worse than the subscription business that what you're seeing, Disney just announced last month that they're doubling their content spend for direct to consumer. And I think, as part of our top 21 for 21 predictions for 21, we actually think at Lightshed that Disney's going to start moving its major films this year, just like HBO did, to streaming. We think you're going to see the same thing happen at Disney. So my guess is you're going to see Black Widow go straight to Disney Plus. And so 2021 is really the year in which all of the studios start to realize they need to figure out a new solution. The traditional window, putting it in movie theaters and then home video, that's just not going to work. They need to come up with a new solution, and the streaming solution is actually a much better business at scale than the old windowed release pattern.
And can all of these streaming businesses survive alongside each other? I mean, I know Disney's got WandaVision out. As of today, I believe there's HBO Max. Some folks on my team just started watching the Tiger Woods documentary, Discovery Plus, Paramount Plus. And then at the same time, we've seen consolidation, and like a company like Quibi, which to be fair is a different model, couldn't survive?
Well, look, just behind me, you have a show called Lupin, which is a French original that is blowing up on Netflix and is the #3 show on Netflix. It's a French original with French acting, French talent, dubbed into English, and it's become a huge hit in the U.S. in just the past week. The point is, all of this stuff is working. Like, people are watching WandaVision, people are watching Soul on Disney Plus, they're watching Lupin, they're watching Cobra Kai season 3 on Netflix. Everyone sort of gets lost. Everyone hears the word streaming wars and they think each of these companies, Disney's going to kill Netflix and Netflix is going to kill HBO Max. What everyone is missing, Emily, is that it's not a war against each other. It's a war in aggregate against legacy television, against the legacy movie theater industry. There's a change in behavior. Like, name a show that you're excited to watch on linear TV. Like, it doesn't exist. Like, all of the great content is flowing to streaming. Yet there are still 78 million homes literally paying $80 to $100 a month for television. That's where it's all coming from. And so, yes, all of these services can scale. Now, some of them are going to be much bigger, like Netflix and Disney Plus and HBO Max, than others. Like, I don't think Discovery Plus ever has ambitions of being Netflix's size and scale. But the reality is, as you take that $80 to $100 a month and you start scaling down so that probably the bundle is just people that love sports, all of that wallet, consumer wallet, gets redeployed to a whole array of these services. And you can pick and choose whichever you want for part of the year or the whole year, whatever you want. It's much, much more consumer friendly than being forced to take everything with a huge bill.
So I got to stop you for a second because you got some big Bachelor and Bachelorette fans on this team, and the new Bachelor just started, which is,
Yep.
you know, of course, a traditional.
Do you have a favorite already? Wait, do you have a favorite already?
Television show, but it is the only one that I can think of.
Yeah. And sure, there's no doubt that there are still some reality TV shows that still work very well. Although if you look at Netflix with some of the reality shows that they've had over the course of the last, 12 months, they've definitely built real buzz in reality in a way that no streaming service ever had before. I mean, not that I'm saying Floor is Lava's great television, but it is remarkable how many people were watching that content.
Okay.
Tiger King. I mean, but I think your point is well taken.
Yeah.
There is still reality TV is still working on traditional broadcast TV. It's shrinking, but it's still working. But all of sort of what I would call dramas and comedies, all of that great content is clearly shifting. And remember, if you love The Bachelor or love The Bachelorette, you can watch it on Hulu.
Rich, we're going to have to leave it there. Lots of great ideas for the weekend. Thanks so much for stopping by. We're going to have more of Bloomberg Technology. Jeff Thomas of NASDAQ with us next. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Following the blockbuster debuts of Affirm and Poshmark this week on the NASDAQ, Bumble has now filed for an IPO and is planning to list on the same exchange. The Israeli-based mobile game maker Playtika and the store Petco, two others that made successful entrances on the NASDAQ this week. Joining us now for more, NASDAQ Senior Vice President and Head of West Coast Listings, Jeff Thomas. Jeff, you've been taking a look at some of the data. Put this into historical perspective for us, because there have already been like dozens of IPOs so far this year. How unusual is that for the second or third week of January?
So start out with 2020. That was a historic year. We had 316 IPOs on NASDAQ that raised $80 billion in capital. Last year, the first 2 weeks of January, we had 3 IPOs. This year, we've already had 48 IPOs, raising over $14 billion.
Wow. So why is the question?
Well, when you look at it, the capital markets are very richly valued right now. So the window is wide open. Of those 48 deals, 10 were operating companies, and they raised over $5.5 billion. And then 38 of those IPOs were SPACs, and they raised over $8 billion, $8.6 billion to be exact. So the SPAC attack is still on. We've got over 250 active SPACs out there looking for targets now. So I think one of the other big stories this year will be all of the business combinations that we're going to be coming to market as well.
All right, we're going to talk about that in a moment, but first I want to talk about the first day pops. Poshmark, for example, soaring 142% which nice to have the momentum, not good to leave money on the table. I spoke with the CEO, Manish Chandra, yesterday. Take a listen to what he had to say about it.
The fact that we are a public company makes me feel great. We're focused very much on the long term, and I think the short-term value creation is not where our focus is. We've been focused on our mission to serve the community, build out a great social marketplace, and just continue to grow and serve.
Okay, Poshmark hitting 150%. That was its high on the first day of trading. Affirm, 110%. Airbnb, 143%. DoorDash, 92%. You know, at a certain point, do we say the bankers are getting this wrong?
Well, I think Manish said it best. You've got to think about the long term. So first, for context, lots of these venture-backed IPOs are only floating about 10% of their shares. Then they're working with their underwriters to put those shares on the IPO into long-term holders' hands. So when we go to open up the IPO on day one with the opening cross, we can't find supply. You have all these buyers that are coming in, placing market orders saying, we want to own the stock. Meanwhile, you have everybody who bought the stock the night before trying to build up a larger position. So it's more of a supply and demand issue. But when you take it back again to the long-term focus, when a company sells stock through their IPO, they're setting certain expectations about their financial performance over the long term. So if the company was to go out and sell stock at the absolute highest price they could, they'd be signing up for much bigger expectations about the results they're going to deliver in the future. So I think it's always best practice, put the stock into long-term holders' hands, let the markets do what you do. And then really it's about the rest of the supply coming to the market once the lockup's off. And that's one of the reasons we continue to have conversations with companies about direct listings as a way to get more supply into the market sooner.
So I get the point about the long term, and we only have 2 days of data with Poshmark, for example, but you know it's down 18% today, and you know over the longer term, that doesn't look good when you talk about the momentum story, which matters. And so I wonder if it's putting these companies in a bad position that they can't seem to get the price right at the start.
Well, all the company can control is working with their underwriters to set the price of the IPO. They really don't control the first day pop or where it trades day two. So again, when you set that IPO price, we've seen a lot of deals pricing above the range. We've seen a lot of demand. And then on day one, when they go public, we've seen a ton of retail demand. And retail investors have really come into the market in a big way. Our chief economist, Phil McIntosh, actually just did a big blog post today about the impact of retail and the impact that has on the IPO market.
So let's talk about trends you're expecting this year. Obviously, SPACs are all the rage. Does that keep up?
Yeah, with already, as I mentioned before, over $8 billion raised in just the first 2 weeks, we've got a steady pipeline of new SPACs coming to market. And then we're in discussions with some great companies who are going to be coming to list on NASDAQ through business combinations. One of the unique aspects of a SPAC business combination that's different than an IPO is that the target company can provide projections about their business because it's really a merger, not an initial public offering. And so for lots of earlier stage companies that want to talk about their future growth potential, a SPAC business combination could be a great alternative to an IPO.
Now, startups are soon going to be allowed by the SEC to raise money on the New York Stock Exchange without paying big underwriting fees to Wall Street banks in what you call primary direct listings. And this is like a pretty big departure from traditional IPOs. And I wonder if you're at all concerned this might drive more companies to the New York Stock Exchange.
Well, so the SEC did approve a direct listing with a capital raise. New York's initial rule filing allowed for a limit order where the stock had to be priced within the range on the cover of the S1. We have a filing for a market order, which actually allows the company to price the stock anywhere from 20% below the bottom of the range, all the way up to wherever the stock wants to price on the day of the auction. We think a market-based order is a much better approach. We'll, of course, be doing a similar filing to New York in terms of having a limit order option for companies so that there's no regulatory arbitrage. But it's just one other example of innovation here at NASDAQ to help drive the capital markets forward.
Okay, so if we saw 48 IPOs in the first 2 weeks of January, what do the second 2 weeks of January look like? We've got an inauguration coming up, hopefully a peaceful transition of power, but it's been a rocky few days in the markets and in the world and certainly Washington, D.C. Will that impact the next 2 weeks?
You know, IPOs are always affected by volatility. We're, of course, all watching the situation in Washington and state capitals around the world and hoping for a peaceful transition of power. But one of the things we will see coming up, we have some great names. We've got Bumble coming up. We've got Qualtrics on the enterprise software side. We've got OrthoClinical on the healthcare side. So lots of exciting names. And then, of course, all the exciting biopharma companies that just announced results at the JP Morgan Healthcare Conference will be hitting the road and looking to price their IPOs over the coming weeks. So a lot of activity coming up.
All right. Jeff Thomas of the NASDAQ. Jeff, always good to have your perspective here. Thank you so much. And if you missed it, by the way, Whitney Wolfe Herd, the CEO of Bumble, was a recent guest on Bloomberg Studio 1.0, so you can check out that past episode if you missed it. All right, coming up, Stitch Fix shares have been on a tear since December after a steady rise throughout 2020. We're going to speak to the company president, Elizabeth Spaulding, about the appetite for apparel companies in the market and where Stitch Fix is heading in 2021. That is next. This is Bloomberg. Poshmark's whopping debut this week has shown that investors are still hungry for growth stocks in retail. As the pandemic ushered in a boom in e-commerce, personalized styling service Stitch Fix has been riding that wave, with shares soaring almost 200% just in the last year. Will the momentum keep up? Joining us now to discuss, Elizabeth Spaulding, president at Stitch Fix. Elizabeth, Stitch Fix is betting that shopping and the way we do that is going to dramatically and radically change. And Stitch Fix has been working on this transformation since long before COVID-19. But what are the trends that you're seeing, and how are customers changing?
Yeah, well, first of all, Emily, thank you so much for having me. Very excited to be here to tell our story. I think one of the reasons we're seeing such great momentum is the innovation in our model. And I think for us, we reported back on Q1 in December, and we just saw some of the strongest momentum we've ever seen in our business, just a number of multi-year highs. We added close to 250,000 new customers within that Q1. And part of it, undoubtedly people are not spending the way that they have historically on apparel, but we really believe that we are the right model at the right time. And to your point on shopping, if you think about the historic Stitch Fix model, what is so radically different about it is that we are hand selecting just a limited number of items for each of our customers based on our understanding of data and all of what we've amassed on personalization. And now what's so exciting is over the course of the last year, we've innovated to add, in addition to what we call our Fix business, a curated shopping feed. And the idea that, you, Emily, can walk into your own personal store. When you open our shopping feed as a consumer, you're not just seeing things that could appeal to anybody. You're seeing things that we think are just right for you. Everything fits, everything meets your style. And that's what we think is really exciting. And people see that our model can be very widely addressable to anybody, whether they want to be styled or to have the ultimate shopping destination for personalized selections.
Now, some specific lines have been seeing a lot of traction. For example, Stitch Fix Kids, which is a fairly new offering. What are you seeing there and why?
Yeah, our kids business has frankly been on fire. And I think there are a lot of parents that are realizing they don't have a lot of time. And I think the convenience and the discovery aspects of Stitch Fix have always been really appealing. But I also think because we're so data-driven, we've been able to pivot into the right inventory at the right time. Our kids, a lot of people wondered, will there be a kids back to school season given COVID and lockdown and people not having regular school but Zoom school? And kids still need clothes. Kids are still growing, whether or not they're maybe not wearing a uniform this year, but they're still wearing those comfy casual clothes. And so our kids business was up 60% during the back to school timeframe. And one of the things that we were really successful with is a good chunk of that business for us are our own exclusive brands. And our fabric platforming strategy allowed us to build product on demand that we needed, replenishing some of our goods as quickly as in 2 weeks.
Kids are still growing and destroying their clothes if you have 3 boys like I do. So yes, they do need to be replenished. When the vaccine rolls out, Elizabeth, and as the vaccine rolls out, we are going to come to some kind of a new normal, even if it takes some time. You know, are people going to go back to physical stores? Are they going to want that traditional old school dressing room experience? And what does that mean for Stitch Fix?
Yeah, it's a great question. I think nobody could predict this has all lasted as long as it had and what it'll be like when we can do all the things that we used to do. But I think undoubtedly consumer behaviors have changed. You know, we look at our own data, we look at market data, and we believe there's been a very accelerated structural shift online. You know, usually it was around couple points a year of apparel would move to e-commerce. And we think that over the course of the last year, more than 10 points has shifted, and we think it's going to stay there and continue to move more quickly. And I think consumers are realizing, you know, 20% of consumers that had never shopped online for apparel back in March and April gave it a shot. And if they tried a company like Stitch Fix, they realized how convenient it is, how easy it is to discover new things. And I just don't think that people are going to want to go back to trying on 10 pairs of jeans in a department store. And, you know, what we're seeing in our data is our retention levels are at all-time highs. Customers are continuing to sign up. And I think what that signals to us is people kind of are voting with their feet that they want to maintain these new behaviors.
Now, I know Stitch Fix has a sort of stable of exclusive brands, and you've been very focused on, you know, larger name brands having exclusive offerings for Stitch Fix. What are the biggest challenges of managing that inventory and supply as, you know, we continue to face the uncertainty of the pandemic?
Yeah, I think everybody has had challenges over the course of the last year with their supply chain, both in operating warehouses, if you're in the distribution business, as well as in having the right product at the right time. And, you know, I think because we are such a data-driven business, we were able to see early on the signals of how consumer behavior was changing. I don't know about you, Emily, but I think most of us might have a nice shirt on, but we're often wearing, you know, leggings and sweatpants right now. And part of that shift we began to see very early on. And luckily, in general, we had seen a casualization in the workforce even before that. But our ability to see that data coming, different success rates of items, our natural language processing of client requests led us to allow us to move into new inventory. You know, our women's athleisure business is 350% year on year. And part of that was the benefit of having that signal data. Even funny things like people binge watching at home. We natural language processed and found that people were requesting sweaters from David from Schitt's Creek, you know, just funny things that people have asked for. And our ability to see those signals allowed us to move into new product categories that are really valued by the consumer right now.
Well, in that case, your sweatpants business must be booming 100%, always wearing them unless forced not to. Stitch Fix president Elizabeth Spaulding. Elizabeth, thanks so much for stopping by. Okay, coming up, how high could Tesla's shares go? Dan Ives of Wedbush talking over $1,200. He's with us next. This is Bloomberg.
I'm Mark Gurman with Bloomberg Technology, and on this week's episode of Power Up, I'm taking a look at Samsung's latest new smartphones to rival the iPhone, as well as the biggest revelations from the virtual Consumer Electronics Show. Due to the pandemic, CES this year was certainly different. Giant hotel ballrooms filled with booths showing off showers that can be controlled with your voice, and next-generation AR and VR headsets were traded in for live-streamed keynotes and virtual versions of booths. Also missing were the key in-person run-ins with tech companies, Apple, Google, Amazon engineers checking out components for devices coming later in the decade, and unfortunately, a clear smash hit announcement. But we still did get a peek at the future of the smartphone with some interesting new tech. Qualcomm announced a new in-screen fingerprint reader that covers more screen area, is more accurate, and works more quickly. That tech could be a precursor to Apple's big iPhone announcement this fall, the first models that will add a fingerprint reader into the screen. That's something, of course, that would have been handy months ago, given the issues with masks and facial recognition. LG also rolled out another look at its rollable screen technology. Apple is still far away from launching its first foldable iPhone or iPad, but LG is already thinking beyond that. Imagine being able to roll up a phone into your pocket, as impractical as that sounds. Samsung showcased a new home robot called the Bot Handy that has arms so it can do the dishes or pour you a drink. It's certainly Jetsons-like, but the issue is the last robot Samsung showed off at CES, the Bali rolling camera robot, still has no release date in sight. Speaking of Samsung, the company also launched their new S21 phone line, including the base S21, S21 Plus with the larger display, and the S21 Ultra to rival the latest iPhones and other devices. The changes to the S21 line aren't especially groundbreaking. They include a much improved camera system and a visually slick-looking new camera array on the back. But the real new territory Samsung is hitting here is a more aggressive pricing strategy. Each new model costs $200 less than the previous version, with the S21 now starting at the same $800 as the iPhone 12, and the S21 Ultra with 100x zoom and a beefier battery coming up against the iPhone 12 Pro Max at $1199. While the new phones aren't an especially impressive leap, the new prices should do wonders to help sales in the current global economy that's still riddled by the pandemic. And this will continue to bolster Samsung's case as the chief alternative to the iPhone. I'm Mark Gurman. This is Power Up.
Our very own Mark Gurman there with this week's Power Up. All right, now moving on to Tesla. Wedbush Securities' Dan Ives has upped his price target from $950 to $1,250 a share. That's bull case scenario. Shares rose almost 750% last year, closing yesterday at $845. Dan upped his target to $950, saying, quote, the heart and lungs of Tesla and the bull thesis are focused on China. So $1,250, Dan, that's pretty high. What gets you there?
Look, right now, I mean, if we look at China, skyrocketed growth. And of course, Tesla is seeing a disproportionate amount of that. And I think we could be looking 250,000 plus units. I think China alone is worth $100 a share to Tesla's stock. That's why right now we're entering a golden age of EVs across the board, and it continues to be Tesla in the lead.
What are the risks? What could slow this down?
Look, the risks are probably twofold. One, right now in terms of competition, this is really across the board on EVs. Competition continues to increase, and ultimately you see share shift going domestically more and more to NIO, XPeng, and others in China. And then in the U.S., you'll see GM and others that are entering the EV race, and Tesla's leadership starts to diminish. I think the second is, of course, just from a valuation perspective, if demand does not meet some of these expectations. And I think, look, as of right now, we're looking at demand that continues to increase versus street expectations 20, 30%. That's why right now in the EV market, there's only a handful of players to play the EV supply chain. It's Tesla's world, and everyone else is paying rent in terms of where we are today in the EV market.
So, that leads to my next question. What are the main factors that are going to get EVs to, let's say, 10% globally by 2025? Is it just Tesla, or are you factoring in a couple of other players? Because Tesla, as you said, it's basically all about them, and everyone else is paying rent.
Yeah, well, I think that's going to be a different story in the next few years. And I think we're seeing even with GM, some of their announcements at CES this week. I think, first off, politically, a Biden administration, a blue Senate is hugely bullish for EVs and just the green agenda. And I think what you're going to see is a doubling down on tax credits. And that's going to benefit not just Tesla, GM, but other players in the EV market in the U.S. And then you look across at Europe and China, right there, it's not just the demand, it's the backdrop. You're seeing more and more lower-priced EVs, the consumer demand increasing, and with a reduced carbon footprint, you're seeing more regulatory and tax credits that are benefiting. That's why right now it's a golden age for EVs across the whole supply chain. We believe you go to 10% of overall automobile sales by 2025 from 3% today. This is really a transformation across the whole auto food chain with not just Tesla. We see another 30, 40 players that will be majorly successful in EV.
And last quick question. We have just about a minute left, Dan. What do you think Biden means for EVs?
It's a Goldilocks scenario in terms of Biden and a blue Senate. because from an EV agenda perspective, you're going to see a doubling down on tax credits. I think first 100 days, this is going to be a major focus in terms of the EV and the green agenda, which is bullish across for the supply chain across the board. And that's something that's starting to get factored into these stocks because the U.S. has lagged. But I do believe Biden in a blue Senate, that's really going to be what could be the catalyst to get the U.S. market to the next step, especially as we start to see much more tax incentives and even some, we'll call build-outs of EV factories across the board that could be government helped.
All right, coming into a golden age for EVs, according to Dan Ives. Dan, always love your metaphors on this show. Thanks so much for joining us, and happy Friday. That does it for this edition of Bloomberg Technology, Bloomberg's Wall Street Week, with my colleague David Weston coming up next. I'm Emily Chang in San Francisco. This is Bloomberg.